Hey everyone, welcome back to Corporate Decoder. Today, John Deere Capital Corp JDC has filed an 8K announcing a new debt issuance, and I'm seeing a clear strategy in play. Quick note, this is not financial advice, just my take on public filings for educational purposes. They are issuing new debt to fund operations and refinance existing obligations, which is a common move. But let's dig into what it means underneath. This is what is called a Form 8K report. Companies file these when something significant happens that investors need to know about right away. Think of it as a news alert straight from the company to the public. Today's filing is a current report, meaning it is about recent events. The date that is important here is the 26th of June 2026. This is when this particular event, the issuance of new notes, took place. The company we are looking at is John Deere Capital Corporation, often shortened to JDC. This entity is part of the larger John Deere conglomerate, and its main job is to finance purchases of Deere equipment for customers and dealers. So JDC is incorporated in Delaware, which is a common state for big companies to set up their legal operations. This 1 to 6,458 number is their commission file number. Think of it as a unique ID for the company with the Securities and Exchange Commission, or SEC, and this 36 to 2,386,361 is their IRS Employer Identification number. It is basically the company's social security number for tax purposes. They are headquartered in Madison, Wisconsin, and here is their main phone number. While most of this filing is about the new debt, it does list some of their outstanding registered securities. The most interesting one here is the 2.00% senior notes due 2031, traded under the symbol JDCC31 on the New York Stock Exchange. This tells us they have existing debt instruments that are publicly traded. JDC is not an emerging growth company. This just means they are a more established player and have to follow all the regular Sec C rules without any special extended deadlines for new accounting standards. Now we get to the meat of the filing. Item 9.01 is where they list the actual documents that support the event being reported. This is the key part. On the 26th of June 2026, John Deere Capital Corporation issued $300 million worth of new debt. These are 4.400% fixed rate senior notes that are due on the 15th of June 2029. They are doing this under an existing registration statement, which is basically a pre-approved plan to issue securities. Think about this, they are borrowing $300 million. That is a massive amount of money, and it signals a strategic decision. Why are they borrowing so much? The filing implies it is to fund ongoing operations and possibly to pay off other debts that are coming due or have higher interest rates. The interest rate here is 4.400%. When we compare this to their existing 2.00% senior notes due in 2031, this new debt is at a significantly higher interest rate. This is important because higher interest payments cut into profits. It suggests that the market conditions for borrowing have changed, or JDC might be taking on debt for a particular project that requires more capital. This type of debt issuance is very common for finance companies. JDC's business model relies on borrowing money to lend it out as loans for John Deere equipment. So when they issue new notes, it is typically to ensure they have enough cash to continue financing those sales. The exhibits filed here are supportive documents. Exhibit 5.1 is an opinion from Kirkland & Ellis LP, a law firm. This is a legal opinion confirming that the new notes are valid and properly issued. It is a standard piece of documentation for a debt offering. Exhibit 23.1 is the consent of that same law firm. They are agreeing that their opinion can be used in this filing. Again, standard practice. And Exhibit 104 is the interactive data file, which makes the information in the filing searchable for computers. So, what does this transaction tell us about JDC on the surface? It is about raising capital. They are essentially tapping the debt markets to get funds. The $300 million amount is substantial, indicating they are either expanding their lending capacity significantly or more likely refinancing older, perhaps cheaper debt with newer debt at a higher rate. This higher interest rate of 4.400% compared to their existing 2.00% notes is a key signal. It suggests that the cost of borrowing has increased. This could be due to rising interest rate environments generally, or it could reflect JDC's specific credit profile at this moment. When a company issues new debt like this, it often means they are anticipating continued growth or need to manage their existing liabilities. For JDC, this likely means they expect to continue financing sales of John Deere equipment and they need the capital to do so. However, the higher interest rate is a concern. If JDC finances a lot of equipment with this new debt, Their overall interest expenses will go up unless they can charge their customers higher financing rates for equipment or their overall sales volume increases substantially. This could put pressure on their profitability. Let's think about this in practical terms. Imagine you have a loan at 2% interest now. You need to take out a new loan, but the best rate you can get is 4.4%. That means for every $100 you borrow, you are now paying an extra $2.40 in interest each year. If you borrow $300 million, that is an extra $7.2 million in annual interest payments. This is not necessarily a bad thing if the company is growing faster and can absorb these costs, but it is a clear indicator that their financing costs are rising. And here we have the signature attesting to the accuracy of this report. Julie M. Rosales, the secretary, has signed off on it. Looking at this filing, my biggest concern is the increase in borrowing costs. While issuing debt is standard for a finance company, the higher interest rate on these new notes could impact future profitability if not managed carefully. The company needs to ensure that its lending activities continue to generate returns that outweigh these increased financing expenses. The risk I am watching is whether this higher borrowing cost will translate into slower earnings growth or even a decline if market conditions tighten further. The strategy appears to be maintaining liquidity and funding capacity, but at a higher price. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.